Ever found yourself in a conundrum about where to invest your money, VOO or JEPI? This is a question that many savvy investors grapple with. Today, we're going to take a closer look at these two investment giants, VOO and JEPI, and see how they stack up against each other. VOO and JEPI are more than just a jumble of letters. They represent two significant exchange-traded funds, or ETFs, that have attracted substantial interest from investors worldwide. But before you decide to put your money into either of them, it's crucial to understand what they are, how they work, and what kind of returns they can offer. We'll be exploring their performance, risk, and potential returns, giving you a comprehensive comparison to help you make an informed choice. So whether you're a seasoned investor or just starting out, this discussion will provide valuable insights for you. Stay tuned as we delve deeper into these two investment behemoths. First off, let's unravel the mystery of VOO. VOO, or the Vanguard S&P 500 ETF, is a popular exchange-traded fund that tracks the performance of the S&P 500 index. This index is a broad, diverse representation of the U.S. stock market, including 500 of the largest companies in the country. Essentially, when you invest in VOO, you're investing in a tiny part of all these companies. VOO has been a consistent performer over the years. Since its inception in 2010, it has provided an average annual return of about 10%. This return rate is pretty commendable, as it's on par with the historical average of the stock market. But it's not just about the returns. VOO is also recognized for its low risk. This is because it's a passively managed fund. Unlike actively managed funds where fund managers frequently buy and sell stocks, VOO simply follows the S&P 500. This means the fund isn't trying to beat the market, it's simply trying to match it. This approach results in lower costs and less risk, as it depends less on the decisions of a fund manager and more on the overall performance of the market. In terms of potential returns, VOO provides a steady growth opportunity. By investing in 500 of the largest U.S. companies, you're not putting all your eggs in one basket. You're spreading out your risk across different sectors and companies, which can lead to more stable returns over time. However, it's important to note that while VOO has historically performed well, past performance is not a guarantee of future results. The value of your investment can go up and down, and there's always the risk that you could lose money. But what about JEPI? Could it be a better choice? Well, stay tuned as we dive into the intricacies of JEPI in the next scene. Now it's time to dissect JEPI. JEPI, or JP Morgan Equity Premium Income ETF, is a novel player in the ETF world. Its primary aim is to provide income with a secondary goal of capital appreciation. This means that while the fund seeks to grow your investment over time, its main focus is on generating a steady income stream. So how does JEPI achieve this? The answer lies in its unique strategy. JEPI uses a combination of investing in S&P 500 stocks and selling options to generate income. This approach is designed to provide consistent income, even in volatile markets, and to offer the potential for capital appreciation when the market is rising. Let's talk about performance. Since its inception in May 2020, JPI has shown impressive results. It has maintained a solid performance while offering a higher yield than many other ETFs. This is an attractive feature for investors who want a combination of growth and income. Now, on to risk. No investment comes without risk, and JEPI is no exception. The fund's strategy of selling options can potentially increase volatility and risk. However, JEPI mitigates this risk by diversifying its holdings across a broad range of sectors and companies within the S&P 500. Finally, let's discuss potential returns. While past performance is not a guarantee of future results, JEPI's strategy of income generation coupled with capital appreciation offers the potential for attractive returns. It's essential to remember, though, that the fund's focus on income means it may not always outperform in a strongly rising market. In summary, JEPI is an intriguing option for investors seeking a steady income stream with the potential for capital growth. Its unique strategy offers a different approach to investing in the S&P 500, and it has demonstrated solid performance since its inception. However, as with any investment, it's crucial to consider your own risk tolerance and financial goals before diving in. Now that we've examined both, it's time to draw some comparisons. On the surface, VOO and JEPI might seem similar, but are they really? Let's delve into the details to find out. When it comes to performance, both VOO and JEPI have shown strong results over the years. VOO, which is an index fund that tracks the S&P 500, has consistently delivered stable returns. It's a reliable option for those who believe in the tried and tested strategy of following the broader market. On the other hand, JEPI, or the JP Morgan Equity Premium Income ETF, uses a more complex strategy. It aims to provide investors with consistent income through selling options along with the potential for capital appreciation. This approach has also proven successful, with JEPI delivering robust returns, especially for those looking for regular income. However, it's not all about performance. Risk and return go hand in hand in the investment world. VOO, being an index fund, carries the inherent risk of the market. If the S&P 500 goes down, so does VOO. But if history is any indication, the market tends to go up in the long run. JEPI, meanwhile, offers a unique risk profile. Its option-selling strategy can help cushion against market downturns, making it potentially less volatile than VOO. But this comes at a cost. The returns of JEPI could be capped if the market rallies significantly, which is a risk not present with VOO. So what are the key differences? VOO offers simplicity and consistency, mirroring the broader market. JEPI, meanwhile, offers a more complex strategy with the potential for steady income and lower volatility, but it could miss out on significant market rallies. The similarities: both are strong performers and can be suitable for different investment goals. Whether you're looking for steady growth with VOO or regular income with JEPI, both ETFs have something to offer. With all these facts on the table, it's time to make a decision. So you have $100,000 to invest. The question is, where does it go, VOO or JEPI? We've taken a deep dive into both these ETFs, understanding their structure, performance, and potential returns. Now it's decision time. VOO, the Vanguard S&P 500 ETF, offers exposure to 500 of the largest U.S. companies, representing a broad cross-section of the U.S. economy. It's a passive fund that aims to replicate the performance of the S&P 500 index. Its low expense ratio and strong historical performance make it an attractive choice for long-term investors seeking consistent growth. On the other hand, we have JEPI, the JP Morgan Equity Premium Income ETF. JEPI employs a more active strategy, using options to generate income and reduce volatility. While it also seeks to provide exposure to large-cap U.S. equities, its unique approach may be more appealing to those looking for regular income and a bit of downside protection. So where does your money go? If you're a long-term investor with a high-risk tolerance looking for broad market exposure and low costs, VOO might be your pick. It's tried, tested, and has proven to be a reliable performer over the years. But if you're an investor who prioritizes income and lower volatility, JEPI could be a better fit. Its option overlay strategy allows for potentially higher income and some protection in volatile markets. Personally, given the current market conditions, I would lean towards VOO. Its broad market exposure and low cost make it a solid choice for long-term growth. But remember, this is a tactical decision based on current market dynamics and my personal risk tolerance. Remember, investing is a personal journey. What works for one may not work for another. So do your own research, understand your financial goals and risk tolerance before making your decision. After all, the best investment is the one that fits your individual needs and circumstances. And there you have it, a comprehensive breakdown of VOO versus JEPI. We've explored the fundamentals of each ETF, delved into their unique features, and compared their performances. Remember, VOO is known for its broad exposure to the largest publicly traded U.S. companies, while JEPI leans towards providing a high income with a potential for capital appreciation. However, the decision of where to invest your $100,000 shouldn't be taken lightly. It's crucial to consider your financial goals, risk tolerance, and investment horizon. Neither VOO nor JEPI is inherently superior. The choice depends on your personal investment strategy. Investing is not a one-size-fits-all game. It's about understanding the market, being aware of your options, and making informed decisions. So continue your research, seek advice, and weigh your options carefully. Don't forget to share your experiences and opinions about these ETFs in the comments. And of course, subscribe for more enlightening financial discussions. Until next time, happy investing.